So it looks like we've got quite a few folks here already. Just want to welcome everyone. Thanks for joining us tonight. My name is Meg. I'm the marketing manager for Roasty Rollers. We're joined here tonight with James Comro of Two Rivers Mortgage and our amazing sponsor, Deb from Welcome to PDX, who's a fantastic realtor. And they are going to give us a presentation on all of the things you want to know about buying your own home, selling your own home, everything that goes into all of that. So just to let everyone know, the way that this will go this evening is I'm going to keep everyone on mute. If you have any questions, please feel free to drop them in the chat box as they come along, and we will answer them as the presentation goes. And then we'll have a little bit of time for Q&A at the end as well. But that being said, Deb and James, do you want to do a little intro of who you are?
Absolutely.
Go ahead, Deb.
I'm Deb Counts-Tabor, a realtor with Portlandia Properties on the Oregon side and Realty One Group on the Washington side. I got licensed in 2006, just in time to watch the market tank once. So I've definitely been around for a while and can work in a bunch of different markets. Got my license on the Washington side in 2015 because I realized that it was just another community around Portland and I should be able to work both sides of the river. So happily can and will do that. I tell people now that my area is the Portland Metro to me is Woodland to Woodburn, Banks to Sandy, but it actually extends past there. I've done deals at the coast. I've done deals as far away as halfway Oregon. So I go where you need to go, basically. And I love what I do. I love sponsoring RCR. So thank you for having me.
And we love having you as a sponsor. James, do you want to introduce yourself?
Yep. I'm James Comro with Two Rivers Mortgage. I've been in the business since 2006, just like Deb, and started right at probably the wrong time, but you all have to start somewhere. So we've owned our own company since 2017. We have a team of 14 people, and we love working with first-time buyers because many of us were first-time buyers once and didn't probably get the education that is needed and desired in order to buy your first house. And so that's my goal now, is to help answer questions, explain things in common sense. Because as I tell people, it's just numbers. So let's show you how the numbers work and then go from there. And I appreciate everyone showing up, and it's great to be a part of the community.
Awesome. We are very lucky to have these two amazing experts with us tonight. So without further ado, Deb, do you want to kick off your presentation?
I will indeed. Awesome. And you guys, I do love answering questions. Like, this is like to me, the teaching part of this is some of my favorite parts. So as you have questions, go ahead and put them in the chat. I'll answer them as we go, as well as doing Q&A at the end, because you learn more by asking questions. And if you have a question, the person next to you is going to have a question, and probably the same question. So don't hesitate to ask. Type away. We'll get them taken care of. I'm going to share this. Okay. So what I tell people in home buying is, right now, the scariest thing for people is getting started. Everybody thinks, oh, someday I'm going to do that. Oh, I might do it. Oh, I'm not sure that we can afford to do it. I don't know. So the joke is, you can do this. You absolutely are okay. There we go. If this can happen, then you can do it, right? If this potato can become vodka, you can become a homeowner. It will happen. So when I'm going through the 101 with everybody, the first thing that I talk about is finding a good lender. And that's one of the reasons that I bring James into these things. Even more important to the process than me is James. the lender is your most important person because um, they're the people holding the money at the end of the day. If we can't, um, if we can't close because the lender messes up, then it doesn't matter how good I am or how fast I talk or how strong I am an advocate for you. I can't change that. So I have great lenders that I recommend. James is top of that list. He's the person I've used for myself. And so I like to have you talk to him first so that he can tell you, here's what it takes to get going. So this is kind of where I turn it over to James. And I'm like, okay, tell us about what we need to do to start the process.
Sounds good. So the first thing I always tell people is don't be scared to talk to us, because I know when I bought my first house, I thought, oh, there's no way I'm going to get qualified. I can't afford this. And so I didn't want to go in and talk to some stuffy banker in a suit behind a closed door and have them tell me that, no, I can't afford this. And then I walk away with my tail between my legs. So what I always tell people is, let's just have an informal conversation and talk and see what makes the most sense. Sometimes people are ready to go. Sometimes we have an action plan to, bump up your credit, work on your credit, to get you, maybe you're not quite ready now, but maybe in 6 months or a year or 2 years, you're ready to go. I just had someone that I started working with 2 years ago that I gave this laundry list of things to do. And then she went dark on me. And then all of a sudden she pops back in and she's like, okay, I'm ready. So I said, okay, let's pull a credit report and see how you're doing. And her credit score went up 200 points in the past 2 years because she followed everything that I told her to do.
That's amazing.
And that's super, super important. And so what couldn't be done in 2019 is now easily obtainable in 2021. So what I usually tell people is lenders kind of work off the 4 C's. We work off what's called capacity, which is looking at your income. Are you W-2'd? Are you hourly? Are you part-time? Are you full-time? How long have you been at your current job? Is it stable? What kind of savings do you have? What kind of funds do you have available? What kind of debt do you have? That's called capacity. Second is called capital, and that's looking at, what other obligations do you have? What kind of cash reserves do you have? And that's sometimes where putting less of a down payment, but keeping extra money in your bank account for after the transaction closes is a better idea than emptying out your bank account to put that extra $2,000 or $3,000 down on the house. And then you move in and then all of a sudden you have no cash reserves. So we kind of look at that too. Third C is called collateral, and that's the property that you're buying. So lenders want to make sure that the property that you're buying is safe and structurally sound and is worth what you're paying for it. So typically we get an appraisal done on the property to determine the value, to make sure that you're not overpaying. And then the last C is credit. This is usually the most important one with first-time buyers, because a lot of times people don't pull their credit and they don't know what's on there and what's not. So we'll look at your credit, we'll look at your score, we look at your history of what you have on there, and sometimes even verify your rent to make sure that you're paying your rent on time. But like I said, it's not a scary process, it's just numbers. And so what I typically do is say, let's sit down and talk about, how much do you make? How much do you spend? Where's your comfort level on your budget, and kind of go from there. And it's a super simple process. It takes 10 minutes on the phone. Deb?
Just had a question come through, which was, how are the forbearance COVID protections going to affect the market this spring and summer?
My thought is most people are still paying their mortgages. So it's not going to affect, as far as people getting loans, it could affect people that are trying to sell and buy. Deb, do you have more input on that?
My my first thing anytime people talk about forbearance is to say, talk to your lender, talk to a lender before you sign any forbearance paperwork, because there can sometimes be, repercussions to that for sure. In terms of, I think when people talk about the forbearance market, especially with regard to, or about forbearance with regard to the market, what they're afraid of is that people are going to stop paying their mortgages, and there's going to be a huge run of foreclosed properties.
Mhm.
And I have to say that what I'm hoping is that for the most part, people are still paying their mortgages to the best that they can. I'm hopeful that there will not be a lot of foreclosures, because that's not something that any of us want. It would be not great, for that to happen.
Yeah, the last statistic that I saw was 7% of people are in forbearance that have conventional loans, and 11% of people are in forbearance that are on FHA, which are government insured loans.
Mhm.
And that was a couple of months ago. But I also know that several lenders have just automatically just put their people into this program for a short period of time. The trick is when you get enrolled in that, you have to figure out how to make up the missed payments. And that's where it gets a little bit dicey, whether it's tacking onto your loan, paying it after the grace period's over. So it'll be interesting to see over the next 6 to 9 months how it all plays out.
Yeah, it's my thought in terms of foreclosure properties isn't that it will be like the 2016 or the 2006 rather market crash, where short sales went into effect and people were selling the houses for less than they owed on them, and they would take forever to sell. There's so little inventory right now that even if that 7% did go onto into a foreclosure and become short sales, they would never be short sales, because the market prices would make it's not going to be enough of an inventory push to drop the prices that much, I don't think. Inventory is what is causing Portland's prices to be so high right now. The Portland metro area is pricing to be so high right now, when there are, okay, Ricardo, I see your question about forbearance is about shifting it from a seller's market to a buyer's market. And I think that what I'm saying kind of answers that question a little bit. It is that what is making this such a strong seller's market is that we have almost no inventory. So, one bakery in town means the baker can charge as much as they want for a loaf of bread. Add another baker and the prices come down. We've been in a dearth of home building in the last 5 to 10 years. So we haven't built enough properties, and we're not moving enough to increase that inventory. And that's what's causing the problem. If it's going to shift it, it will be a shift, but I don't know that it'll be enough to make it go to more of a buyer's market. I think it might balance it a little bit. And I would dearly love to see some balance in the market. And if that didn't answer the question, please feel free to keep adding questions for sure.
And there's another question about paying off credit cards or keeping money in savings.
Mm-hmm.
That's a fantastic question. So what I always tell people is keep your liquid money. And you can always pay, like I've had people that have had to pay off one specific credit card to qualify. So we can do that if you have the liquid savings. But once you pay down your debt, you can't really pull it back out if you need it for something else. So liquid reserves are always going to be the best, because we can put them towards different places at the end. So that's a fantastic question.
James, I was going to ask you about on checking credit scores. How are things like Credit Karma in terms of reality versus Zillow pricing?
Credit Karma, in my experience, has been somewhat accurate. But we pull what's called a tri-merge mortgage pull, which weighs things different than a consumer pull. So just the same as if you go to get a car loan, they pull an auto pull and it scores things different. So that's why when we pull a credit report, we pull all three credit bureaus on the same report, which is Experian, TransUnion, and Equifax. And then we drop the high score and we drop the low score, and we use the middle score for pricing. Because even though everything could be reporting exactly the same on all the credit bureaus, the way that they score is different. And so you can have a exact same report and you get three different scores. So that's why we do it that way. So I have the same thing with my bank. I log onto my bank and it tells me my credit score. But then if I go pull my credit score, it's not going to be that because they just use a different model than what we use.
Okay. So it is a lot like Zillow.
Mhm. Yes.
Okay. So the joke for you guys is that the price that Zillow gives you is wildly inaccurate. So I wanted to make sure, see, because I use Credit Karma too, to kind of track a baseline of what my score is, but I use it the same way that I would use Zillow pricing, which is here's a sort of a roundabout number, but for details, I want a professional.
And I think Credit Karma is good if like you're kind of tracking your score and nothing's changed in your debt situation, but suddenly your score changes, 20 points, then that typically means something's up. So you'll want to kind of look and see what that is. But I mean, it's a good tool. It's one of the many toolboxes that people have to use.
And for people who are nervous about their credit in terms of, thinking that the number is too low, what's the conventional estimate right now? What's the limit?
So conventional is 620. And FHA, we have a couple of lenders that go down to 500. But of course, that means that your interest rate's not quite as attractive because that's a risk factor on the loan. And so, if your credit score, we look at it and then we also look at what can we do to bump it up if we need to. So like I just had someone that was at a 719, and if we can get it up to 720, their payment went down about $50 a month. And so I have a tool that I can use that says, hey, here's the score we're trying to get. What do we need to do that? And it came back and said, if you pay this one credit card down $300, your score is going to go up. So I'm like, hey, you've got some cash reserves. Do you want to try this? And so he paid it down to $300. We rescored, and his score went up to like 740. So it worked just like it was supposed to do. So that was a good investment of $300.
Yeah. And this is why I recommend talking to your lender, before you think you're ready, because a good lender can get you ready, can help you answer the questions about how, what do I do to get to this point so that I'm actually able to buy. And I have clients who have done the exact same thing as James was talking about, who went off to a lender, said, okay, we need to do X, Y, and Z. We'll talk to you in a year. Came back in a year, came back and went dark, came back in 2 years and said, okay, we did everything. Now we're ready to buy. Right. And I know when I did mine, because I stopped using credit cards in 2011. Yeah, I stopped using credit cards entirely in 2011. So for me, my scoring wasn't so much it was bad scoring as it was I didn't have anything to count against. And so when I was ready to purchase my home, purchase my new place, I went out and I got a Capital One, cheapo Capital One card. I went out and bought $100 worth of stuff on it, turned around and paid it off, did it again for another week, did it again another week, and within a month, my score went up 60 points. At the end of the month, it was up 60 points. So sometimes it's as simple as that. Pay down this, add this, and you can get to that point really quickly. So, but you don't know, because we're sitting here going, oh, I think I can't afford to do this, or I don't have the credit score for it. My opinion is that we always work better when we're coming from a position of information. So go talk to the people who can give you the information.
So I have a question about that. Is it possible to purchase a home without having any previous credit score whatsoever and without getting a credit card?
Yes, there is, some lenders do offer a no credit score program, and the pricing again is not as sharp because it's higher risk, because the lender is going to say, well, we have no documentation that, she can pay her $30 Visa bill on time, so why are we going to give her a $300,000 home loan? So again, you can do it. Sometimes the lender is going to say, hey, we want proof that you paid, what other monthly debt do you have that you've paid on time consistently? Rent, uh, cell phone bill, utility bill, just something that can show a history, because you don't have to have previous credit to purchase a house, but it's going to help you in your scoring.
Awesome. And then there's a follow-up question in the chat, which is, in a 2-income household, do they average you and your partner's score or take the highest score?
That's a great question. So we actually take the middle score of each person, as we talked about a little bit ago, and then we use the lower of the 2 middle scores. So it's like the worst case scenario. So where that can sometimes play into effect is if one person has really good credit and one person has marginal credit, can we put the loan just in the person with the great credit's name, leave the marginal person off the loan, because that's going to affect your pricing. So that's another thing that we look at for multiple borrowers on the same loan. That's a good question.
If you have like 3 or 4 borrowers as well, right? Same
Correct.
thought process.
Lowest of every person, yeah.
Yeah. So if you're looking at a friend group to purchase with, it would be the same thing. All right. I'm going to start talking about the process as it works, as the money works into it. And so the other biggest fear, other than credit, that people have are down payment. And everybody thinks, oh, I have to have 20% down. You do not have to have 20% down saved to purchase a home, right?
That's correct.
If you have a VA option where you are military of any kind, you can buy a house with 0 down. There are many, many programs that James has access to where you can buy with as little as 3% down. So don't feel like that 20% down payment is where you have to be. What you do have to pay if you don't have 20% down is mortgage insurance, but that can be removed after a certain period of time by refinancing if you were on an FHA loan, or just by loan to value getting to 80% if you're on a regular loan. The other thing that people don't think about is they're like, well, I have to have this down payment. I've got to have 20% or I've got to have 5%, but they don't know that they also need to have closing costs. So I always like to make sure that whoever your lender is that you're working with is super clear on what I call your cash to close. How much money do you have to have in hand to close the deal? So to come to the end. So that's going to be your down payment plus your closing costs. Your closing costs are your first year of homeowner's insurance, usually about $1,000. Your first year of taxes, or a portion of your first year of taxes, depending on where you purchased in the year. It's going to be things like how the lender makes their money. That fee is going to be in there. How the title company makes their money. That fee is going to be in there. So how the city makes and the county makes their money for recording, because they're going to charge $25 or $50 or $100 to record the deed. This is all the places that everybody makes money off of this, and that's where the closing costs come from. So
I usually tell people plan on about $4,000 for closing costs, which is underwriting fee, appraisal, county recording fees, title search costs, plus a year of property taxes, plus a year of homeowners insurance.
Yep.
And we always give you an estimate before you write the offer that has the estimated payment on it broken down, plus your costs to show how much you're going to need to close. Because I'd rather have the discussion now versus after you get an accepted offer and you're like, oh, wait, I didn't know I had to have that.
Oh, we can't afford that right now.
Yeah.
Yeah. So, yeah. So a good lender will make sure that you know what that number is, and I will make sure that we know what that number is. So it's like, if I find something that we love, I'm going to send it out to the lender and say, okay, just in case, if we made this full price offer, we made this offer, what would your monthly payment, what would your cash to close be, so that everybody knows. So your closing costs around 4,000 or 5,000, your down payment, and then your other upfront costs are your inspection costs and your earnest money. And we'll talk about earnest money down the road. Your inspection costs that you need to have financial or have money ready for are your general inspection, which is about $500 to $600. Radon test is $150, and a sewer scope is $150. Those three things I absolutely say get those three things. The general inspector is going to come and look in all the nooks and crannies for us, and then the radon and sewer are going to look into the things that we can't look into. We can't test the air. We can't look for what's going on in the sewer lines. That's why we have people who do those things for us. After that, there are a ton of other things that we can test for, but when you're talking about how much money do we need to have, your down payment, your closing costs, about $1,000 for inspections, and then we go from there. Okay. So once you've gotten approved, we're ready to go, then we get to go into the fun part, which is looking for houses. So I will start a home search for you before you've ever talked to a lender. But given how strong a seller's market it is right now, I try not to write you an offer until you've gotten pre-approved. Simply because without that pre-approval letter attached to our offer, we're competing against 4 or 5 other people probably, and we're not going to get an acceptance because we're not ready. They've got other people backed up and ready to go. So we want to be as ready as we can be as well. This is where I do consider home searching the fun part. I love looking at homes with people, without a doubt. What I want to set an expectation of in this market especially is that it's a very strong seller's market, and we have to come up with ways to make your offer stand out. James, you can go ahead and go and answer.
Yeah, so the question is 4% interest a good rate for a 0 down loan with no extra insurance for not having a down payment? On a VA loan, no. On a conventional loan, yes. So what the lender, there's a couple lenders in town, I think OnPoint and KeyBank, if I believe, have 0 down loans. They basically hold those loans on their books instead of selling them on the secondary market. But because there's no down payment, that's higher risk, and they can't get mortgage insurance with no down payment. So what they do is they raise the interest rate to absorb that risk. So you're paying more every month for not having a down payment. So some people start with that, and then they wait until they have enough equity, and then they refinance out of it into a regular loan that has a lower interest rate. So there's different options that are available for that.
And then Ricardo says, my friend was outbid 9 different times, is offering more than offering price, a trend that we can expect to continue. Unfortunately, yes. And until we've got a more balanced market, I do believe so. I am not an agent who is going to recommend that you pay more than appraised value, though. So here's the kicker in this market. There are 3 different numbers that we're looking at. Okay, there's the list price of the property. So say Portland Metro's average is about 450, median 450, average 475, or the other way around. I don't remember right offhand. Anyway, say 450. So if you're writing an offer and the list price on the house is $450,000, and I come and I tell you, I've looked at the numbers and I've shared with you the comparable sales for that house. And I have to say that I'm actually pretty darn good at this from an appraisal standpoint. I've had a handful of low appraisals in the hundreds that I've done, in the hundreds of sales that I've done. I'm pretty good at saying what I think an appraised value will be for a property. So say I come to you and I say, I think that this will appraise at 475. It's listed at 450. I think I could convince an appraiser to give us 475 for it. But your approved, what James has approved you for is only 460, right? So 450 is the list price, 475 is what I think I can get it for, but 460 is all you can afford. But your mom says, well, I'll give you $15,000 to bring up that difference if you do that. I'm never going to recommend that you do that, because if the market goes bloop, or if you have an emergency and for some reason you have to sell the house next year, you're not necessarily going to make up that $15,000 difference. I don't want you to be owing more than the house is worth for a long period of time. And the higher, the more you pay out of pocket, the more that is. So what I try to help you find in the numbers that we're looking at, here's what I can justify to an appraiser. Here's what it's listed at. Here's what you're approved for. What we need to find in there is what I call your ass kicking point. So at what point in there will you be mad at yourself if you lost the house? So if you find out that you were outbid by $1,000 and the person who bid $1,000 more got it, will you be mad at yourself because you lost it for $1,000? Will you be mad at yourself if you lost it for $5,000? Will you be mad at yourself if you lost it for $500? And that's what we consider. You're going to get company. Sorry, guys. That's what we consider. That's what I consider your ass kicking point, because I've been there. I actually lost out on a house that I would have bid more on if I had known this. And I lost it by $500. And it's like, I could have bid that extra $500. So I like to set that expectation. Know what your ass kicking point is, make that highest and best offer. And if you don't get it, then don't feel bad about it. Don't second guess yourself. You did the best that you could, and we'll move on to the next one. Okay. That way you're prepared for the process. So
And that being said, I have a friend of mine. Yeah, I have a friend of mine that put an offer on a house a week and a half ago. It went on the market at 520, and she offered, it just went on the market. She offered 510, and I thought, oh, this is going to be a waste of time because I know how this market is. And the seller didn't get any other offers. And so they countered back at 520, and my client was like, great, we'll do it. So not anything over asking. She went in under and just got right back to the 0 point. So that it can happen. So, you know, what I always tell people is, if you like a house, write an offer on it, because the worst that can happen is they're going to tell you no, or they're going to counter with another number.
Exactly.
But you don't know until you try.
And I always tell my sellers, you know, a buyer took an hour out of their time, you know, a couple hours out of their time to come and look at this house and put together an offer for it. The least you can do is counter it. You know, if it's not the offer you like, at least counter it. That way they know that you looked at it. You know, if they don't have any other offers, they're going to do that. If they have 20 offers, maybe not. If they have 20 other offers, we may never hear from them again, except when we see that it goes pending. And I like to set that expectation as well. We're not always going to get notification from the seller that they saw our offer and that they're not getting it, you know, that we're not getting it. Hopefully, but it depends on how busy and how lazy the listing agent is, unfortunately. So I like to try and set those expectations up front as much as I possibly can. I know that I've had clients this last year who were able to go out and, yeah, that's a really good question, and I have an answer to that. I have clients who went out and within the first 2 weekends of looking at houses found something they liked, made a strong offer, got into it. I have other clients this year who took 6 months to find the right place and wrote probably 7. I think at final count we saw 70 houses and wrote 9 offers before we got a yes. So it can happen like that. And I am not going to be impatient with you. If we have to look at 70 houses, we'll look at 70 houses. That's okay, right? Not a problem. But if we look and look at 6 and find the right one, I'm okay with that too. So the question was, can you offer services besides money as part of the offer? So the tricks that I have for getting offers accepted are be solidly pre-approved, make sure that you know that you're writing the offer to the point that you're comfortable with and not above it, but not below it. Go ahead and write to the strongest point. I always call this listing agent ahead of time and find out if they'll tell me what the seller needs. So is the seller looking for a faster close? And then we'll check with the lender and say, hey, what's the quickest you can do this? Usually 30 days, sometimes 45 days. Right now, because of appraisals taking longer, we can't always get that sliced down, but we can try. We can limit the amount of limit the time it's going to take doing inspections, which I can often do because as soon as we write an offer, I get in touch with my favorite inspectors and say, hey, do you have time in the next 5 days? Because I'm sending this offer out. I don't have the yes yet, but I'd like to get kind of penciled in on your schedule. And because they've worked with me a ton, they're willing to do that. So we can shorten your inspection period. We can, one of the things that has worked well for me so far this last 6 months has been to say that we will limit our repair requests. So if we get into the property and we do our inspections and the bids or the work that needs to be done is less than $5,000, we won't ask for repairs. We'll just go ahead and accept it as it is and deal with doing the repairs ourselves after we've purchased the property. So like if the radon comes in high, radon remediation is about a $2,000 job. We'll take that on. We're not going to ask the seller to take care of it because we know what it's going to cost and we'll just do it. If there's a sewer line that needs to be replaced and it's a $20,000 job, then that we will negotiate, but we'll do less negotiating on the repair side. Sorry. So we'll do less negotiating on the repair side, and that can actually get us an offer. I've gotten it into a couple of different places where we've said we won't ask for a ton of work. And then of course, as soon as the repair inspections come back, I'm still asking them to get work done. I'm not going to say no to asking them for anything. We can also ask sellers to cover part of your closing costs, just as an aside, back to the lending part of it. We can, if you need help covering those closing costs, we can say, hey, we're going to offer you $5,000 more for the price of the house if you'll cover $5,000 of our closing costs. And it's perfectly legal. And it just means that you're paying your own closing costs over the life of the loan as opposed to upfront at the end. So, and then the last one, the last thing that I can do is if there's any service, and think about this and kind of be thinking about it. If there's anything that you can provide, if you have a friend who has a vacation house someplace, if you run a food cart or something, when in 2006, 2007, when it was such a strong buyer's market, that sellers were desperate to get people in, the door to buy their houses. They were giving away bonuses, selling bonuses to or buyer's agents, but more importantly, they were offering incentives to the buyers. They said, if you buy our house, we'll give you a weekend at the coast, or we'll, buy you a cruise, or we'll leave the flat screen TV, which were just, becoming popular at the time. Or one notable thing that I think you can look up, there was a guy in Portland who was selling his house, and he ran a pizza joint here in town. And so he gave away, I think it was a lifetime supply of pizza, free pizza once a week for the rest of your life if you would buy his house. So I tell my buyers, whatever it takes to get us noticed. And if one of those things is, that you've got something that you can give the seller on top of money, then let's put that in there. Absolutely. And we put it in at no value so that the lender doesn't have to worry about it. And it just goes as part of the deal. I haven't had anybody who's able to do it yet, but if I can and we've got it, then we'll do it. So. And then Ricardo had to backtrack.
There's a question on pre-approvals, the expiration. So technically, because of COVID, all of your documentation needs to be current within 60 days. That being said, on day 61, I'm not going to call you and say, I need this and this now. What I always tell people is, if anything in your financial window gets worse, you have a pay cut at work. You start working less hours. You suddenly have to buy a car on credit. Anything kind of gets worse, then just let me know and I'll just make a note in your file and we'll adjust the numbers as necessary. And then when your offer is accepted, that's when I come back and say, okay, all your paperwork we have is from November and it's now January. So now we need to get your most current pay stub and your most recent bank statement and we'll be ready to go. That's a good question.
All right. So what happens when they say yes? So we've made it through all of this process and we've gotten somebody to say yes to our offer. Now what do we do? So this is where we drop back to earnest money. And we talk about that. Your earnest money this is your promise to the seller that you're not going to walk away from the deal. Okay. It's usually right around 1%, 1.5% of the sale, but it is returnable to you if the inspections don't turn out well or if your financing fails. So if, something goes wrong and you lose your job midway through or something and you can't complete it, you get your earnest money back. If we do our inspections and you discover that there's just more work than you're willing to take on in this house, as long as we retreat during our inspection period, you get that money back again. It does not stay with the seller unless you walk away for no reason. Okay. So that's the last chunk of money that you need to have available in the first week of getting the yes. And so again, it's inspection money. So about $1,000 for inspection, 1.5% for your earnest money. And then the other money that you have to have is comes at the end, and that's your closing costs and your down payment. And your earnest money is deducted. A chunk of your down payment that you are prepaying. So.
Right, and the earnest money is deducted from the money that you need at closing. So if you write a check for $4,000 as earnest money, that's going to be deducted from what you owe at the end of the transaction. So it doesn't just disappear. You don't really get it refunded, but it just applies towards your future bill that you have to pay.
Yep, it's part of your down payment, just already prepaid. Okay, so the inspections we sort of talked about a little bit, but we go through the initial negotiation to get you to your yes. And then all of real estate is very much do a lot of stuff up front real fast and then sit and wait. So during this period, this is everything happens really fast period. You have to turn your earnest money in, you have to get your inspections done, and then we do more negotiating. So during that inspection period, we could get everything from the general inspection I talked about, the radon and the sewer scopes, those all have to be done. And then say their inspector comes in and says, you have a lot of dry rot under the house, or you have a very wet crawl space. Like I'm working on one right now where the house was built in the mid 70s and it never had a vapor barrier put under it ever. So vapor barrier is that thin plastic stuff that you put under your house that keeps all the wetness from coming up into your house. So you don't get all that moisture coming up into the home. And so everything under the house is kind of wet, and it's never been fixed. So we're going through and getting a lot of bids for what needs to be done. And then we're going to renegotiate with that listing agent to go back to those sellers and say, okay, we've offered you this amount of money. Now we need you to reduce the price of the house, cover some of our closing costs, and do these repairs. So as you look at the inspection report, what we're making a note of is, what do I want to take on myself as the buyer? What am I willing to do myself? And what do I want done before I walk in the door of the property? And then we negotiate that with the sellers. So you're never required to walk in and say, I'll take everything. But I like to set that expectation to say, if the sellers say no to all of this, do you still want to buy the property? And sometimes that happens. Sometimes the seller says, I'm not going to do anything. We're just going to give you a credit. And if that's the case, do you still want to buy the house and then just deal with everything yourself afterwards? So it runs a range, but I will work with you on getting all of it taken care of. And I'm pretty good at that negotiating. So Nick asks, if you've paid your earnest money and your inspections were fine, but you just change your mind and get cold feet, do you retrieve your earnest money? And that is where you lose your earnest money. That is the seller's promise that you're not going to do exactly that. That is their only, there's a specific word for it, but it's what they get if you walk away. So it has to be enough to make it hurt you a little bit. So you can't say, I'm going to put $500 earnest money on this, because no seller is going to look at that and go, oh, that's a fair thing. They'll be like, oh, that's easy to walk away from. So
Deb, is it true that you can back out for any reason though during your inspection process?
You can back out for any reason during your inspection process.
So even if it came back fine and you had 10 days and you were in day number 9 and you're like, what am I doing? This is crazy.
Yep, you absolutely can. And you can back out at that point.
And you get your earnest money back.
And you get your earnest money
There was
back.
a little bit of an off.
Yep. Yeah, you've got that time. Even if inspections are fine. I mean, even if the inspections are fine and everything is okay and you've just changed your mind, as long as you're within those 10 days and we haven't released that contingency, we're okay. If we on day 8 said, hey, the inspections are fine, we don't want to negotiate, or we've negotiated it all already, and then you change your mind, then you don't get it back. Then it's theirs. So we go through all of this inspections and all of that, and we do our repairs and we come to an agreement on that. And that's where we get to the sitting around and waiting part. This is another chunk of money, but it is part of, usually, James, how is appraisal covered, right? Paid for on, is it a closing cost or is it a credit card cost right now?
It can go either way. So probably 75% of our clients pay for it on their credit card.
Okay.
And then there's times when we pay for it as a company and we bill it at closing.
Okay.
That usually happens if the borrower's kind of tight on funds, or if it's a shorter close and we need to order the appraisal right out of the gate. And that way, if for some reason you back out, we absorb the cost of the appraisal. We don't make you pay for it. And then if the loan closes, then we have you pay for it. So it kind of just depends. But most of the time, probably 3/4 of the time, the buyer pays for it when we order it.
And they're running about $800 right now?
Yeah, they're $725 to $800, depending on the lender that we use. So we're a broker, and so we work with a bunch of different lenders, and they each have individual costs and fees. And then a lot of it too depends on how quickly you have to get it back. Like if you have to get it back super fast, you may have to pay extra to get it back. So that's another reason why we try to time it to make it the process the most cost effective for you and the least stressful.
So I am of the camp that doesn't order appraisals, or will order appraisal. Say we've got a 10-day inspection period. I'll usually order the appraisal on day 5, between day 5 and day 7, before we've come to an agreement, but not so far out that when they call me to make the appointment, I can't say, hey, we're not quite ready yet. Let me call you when we are, so that we're adjusting that timeline, because I don't want you as a buyer to pay for an appraisal when we haven't come to an agreement on the details of the inspection repairs yet, right?
Right.
So I'm always real careful to balance that, you know, when we order it versus when we schedule it, so that you're not going to end up paying for something that that you don't need. So, but it is an additional cost, so I like to let people know that that's there. And this is where we're in this sit around and wait period, and it's everybody's least favorite period. We just kind of we've gone through all the stress of the repair negotiations, and now we're not doing anything, and it feels like nothing's happening. What's actually happening is all behind the scenes. James's team is doing their job in ordering their appraisal, and then underwriting is looking at everything to make sure that they can still loan on the property and on you as a buyer. So James, most of the banks that you're working with don't do a lot of, like they do house underwriting, but they're not like looking at every detail or anything. They look at what the appraiser comes in with as opposed to looking at the inspection, right?
Right. I never send an inspection to a lender.
Okay.
And if I ask for it, I will push back and escalate it until that condition goes away, because that is an inspection is not a requirement of the home loan.
Mhm.
And so, you know, where it gets a little bit dicey is when, and Deb knows better, she never does this, but I've had agents that have said, in lieu of fixing leaking roof, seller shall pay buyer $5,000 of closing costs. You can't say stuff like that, because then the lender goes, wait a minute, our collateral's roof is leaking. That's a problem.
There's a
And
leaking roof.
so,
What are you talking about?
right. So if I get addendums like that, I circle back around. I'm like, we need to reword this, because you
Well,
can't
I just
say
did
that.
one, just finished it yesterday. In fact, we came to agreement on repairs on one where we had a bunch of stuff that we wanted the seller to take care of prior to close, and then a bunch of stuff that the buyer was more than happy to deal with himself afterward. Like, needs a new water heater, but he'll put it in himself because he's got a buddy who can do it. And it needs some new windows, but he'll do it himself because he works in that industry. But it also had a crawl space that needed to be put a sump pump in, and some mold remediation that needed done that we want taken care of before we move in. So I did 2 different addendums. One is the repair addendum asking for the seller to do all of this stuff, and one was a $5,000 credit. They're 2 completely separate addendums, and one's going to go to the bank and one is not. So that's how you're supposed to do it, so that there's no question. But I've had appraisers come and ask me for all kinds of, or underwriting come and ask me for stuff. Like I did a property once where the sellers had, between the inspection and the appraiser coming out, had the water turned off because, you know, everything's done. Why should we continue paying for the water bill? Except that then when the appraiser came out, the water wasn't on. And so it went into the appraisal that there was no water to the house. So I had to have, so the underwriting called me and said, why is the water off? So I had to call the seller's agent, have them turn the water back on. And then I had to go out the day before, no, the day we closed, and take a picture of the water in the kitchen sink running far enough back that they could tell that it was the same house. So turn the water on, step back, take a picture, and send it over to my lender and say, okay, give this to your underwriting team so that they can see, so that we can close this tomorrow. So sometimes things like that happen, and I will probably never tell you about them until way after the fact because you don't need to know about them as a buyer. I just take care of it. So, Oregon, once we get the appraisal back and James's underwriting team has done their thing, they will send us what's called clear to close, magic words, or also known as docs are at title. So it means that the documents have been given to the escrow and title company. Escrow is our neutral third party. They're the people who handle all of the money. And they're the ones who sit you down to close. I hate, hate, hate that I am no longer allowed to attend closings, most companies, because they only want the principals in. So I will usually ask you to call me in or Zoom me in for your closing because I hate that I've walked you through this whole process and then handed you off to a stranger for the scariest part, which is signing a stack of papers like this high. So I'll always try to be there in any way, shape, or form that I can. It doesn't always work, but I try. You sign your stuff, and you sit down and you sign all of those papers, and it does have to be an in-person thing. So you either have to have a mobile notary come to your home and they will be masked, or you go to the title company and they'll be masked. Then all of those papers go back to the lender and the lender checks your credit scores and stuff one more time. So between signing and getting your keys, do not do anything to change your credit score. Don't go buy a car, don't go buy furniture for the new house, don't go buy appliances for the new house, unless you have a ready fund of cash and you don't tell anybody about it, right? So nothing that will change your credit score because they'll check it one more time. And then the next day they'll send us a note saying that they have funded. And then the county and then the escrow company will send us a note saying they have recorded the deed with the county. And then I get to give you your keys. So that is the magic time.
What would happen if your credit score changes? Like say you didn't know that that was a thing and you made a mistake of making an investment of some kind. What's the worst case scenario there?
Worst case I've had happen is I had to call the client the day before funding and say, you now cannot buy this house.
Yeah.
Because you bought a car 2 days ago that showed up on there was inquiry on her credit report. And the lender called me and said, hey, this person's at closing and there's an inquiry from Broadway Toyota. Can you please find out what's going on? And so I had to call her, and obviously she was a realtor. And I'm like, you didn't go buy a car, right? And she's like, I did. I'm like, did you pay cash for it? And she said, no, I financed it. And I said, well, send me your paperwork. And her $500 and some a month payment pushed her over the edge of what she could afford to buy. Mm-hmm. And so she did not get to buy the house. And of course, that doesn't qualify, and she lost earnest money.
Yeah.
So they'll do one right before closing. Typically, they do one credit refresh to make sure that you haven't applied for any new credit cards, your debt hasn't changed any. And then they'll do one final employment check. So it had a person that signed their closing documents on a Wednesday and quit their job on Thursday. And Friday morning, we called to verify their employment, and they said they gave their 2 weeks notice yesterday. Well, that's a problem. And so that person's still renting too. So like I said, if anything changes in your financial before you do it, talk to me, because sometimes it's okay. My husband quit his job in the middle of us buying the house that we live in right now, and we knew better, but we just did it. But we had a plan, and we were able to make it work.
And sometimes
so
you don't have a
you just have to
plan.
know.
Yeah, sometimes you don't have a plan and it can still work, but we gotta communicate it. Like
Right.
I had a buyer once who worked in the mortgage industry, and she midway through, and this was I think 2008, 2009. So understandably a little iffy in the industry, and she got laid off midway through her home purchase. And she, of course, she knew a ton of people in the industry. So she got laid off on Wednesday. By Friday, she had 3 interviews lined up. And by Wednesday of the next week, she had a new job. And so it did not change anything for her. She was still in the same industry. She was still making the same or more money. And so it wasn't a bad thing, but it's definitely a stay in contact with your lender
Mhm.
thing. So that there are no surprises, because things happen and we get that. And to the best that we can, we'll work within those things. So I just like to encourage people, or to set that expectation that there's signing, then there's closing, and then you get your keys. So that is how that goes. Market update. So the biggest, it's a toss up in Portland if people want to talk um, about COVID's effects versus the seller's market that we're in. And the biggest change that I've seen to the market because of the virus is that people are needing to be in places that fit a work from home lifestyle better. There's more of a need for a home office as opposed to a bedroom or a shared space that can be used as an office. So people are saying, where we used to say, well, we'll be fine with 2 or 3 bedrooms. Now it's, we need 3 or 4 bedrooms because we both work from home and we're both on the phone a lot. We can't share an office space, or we need a kid space, or with that. That's the biggest thing, is that additional space. So where the trend had been, especially for um, um, Gen Z and millennials, the trend had been to smaller spaces. It has done a rapid fire shift back to larger homes, which was the biggest surprise for me, but I mean, not a surprise, but it was definitely a trend. We were trending away from bigger homes, and that was just an absolute 180. And then you'll hear a lot in the media, and I think that this is a little bit disingenuous about people, fleeing to the suburbs. And there isn't a flight to the suburbs. There's a flight to wherever people feel the most comfortable. And for some people, working from home and being from home at home all the time means we need more yard space. We need to be able to go out and do things. But for some people that I've worked with, it means I want to know my neighbors better. I want to live in a close in, Portland community neighborhood where all the houses are very close to one another and I get to know my neighbors better. I think that is what I have seen the biggest change, is that whatever you wanted, you want it more now. Whatever was your true heart's desire in terms of living someplace, the fact that we're staying in our homes the way that we are means, what was acceptable if we were just living there but we could go out is somehow no longer acceptable. So does that mean that people may be making changes now that aren't necessarily necessary in 9 months or a year? Hopefully. I really, really hope so. I really hope that in a year, we don't have to stay in our homes so much. So we won't have to worry about it quite so much. In terms of selling season, what used to be the good season for selling your home was spring, which started earlier and earlier every year. Now, given the lack of inventory in Portland, there's no one good selling season, which means there's no one good buying season either. You're just as likely to be going up against multiple offers in November as you are in July or June or May. So it's more a question of setting our expectations and understanding that that's something that we're going to be going up against than it is to worry about, is this the right time? Any time right now is the right time.
And my busiest month of the year is June, and my second busiest month is December.
Isn't that interesting? That's mine too. My busiest close is July and December for my 2 busiest close months. Historically, it's always been like that. I've delivered keys on New Year's Eve more times than I can tell you. So So that really kind of takes us up to the, the crystal ball section, which is, just ask me questions and let's see what we can do. If you want to unmute folks, Meg, so that they can ask questions, that would be super. And I'll unshare the screen so that we can kind of see each other. And then I'll answer Ricardo's question while we're getting that done, which is, when you buy a condo townhome, you don't own the land it's on. How much protection do you have that the landowners don't sell the property from under you? When you buy a townhome, you do own, Oregon's not a leased land place like in Hawaii, where almost always that's the case. There, I can think of 2, maybe 3, right off the top of my head, places on the east side where the condo units are on leased land. And they have to update that for 100-year terms. And it has to be more than 30 years away before it can get lent, before you can get money on it, before the loan on it. So you're fine for any place in the Portland metro area as long as it doesn't say it's leased land. And that's, again, I can think of, there's a condo complex on a townhome complex on 148th and Rose Parkway that's leased land. There's another at Division and 162nd just north of Division. And I think there's one other, but those 2 I know really well because I've looked at condos in both of them, or looked at townhomes in both of them, because they're really nice townhomes. You don't own the land, and it's leased in a way that it could get sold out from under you.
Right, and from the lending standpoint, they will not lend unless the land portion of the lease is longer than your mortgage. So if you have a 30-year mortgage, the lease on the land has to be longer than 30 years to go, because the lender doesn't want their collateral to be in jeopardy either.
Mm-hmm. Yeah, it's far more common to do the leased land stuff in Hawaii than it is here. So I haven't gotten my Hawaiian license yet, although it's on my list of things to do. Right.
Great. I think that I've unmuted everybody. If anybody wants to shout out any more questions or drop them in the chat while we have a few minutes left.
Yeah. You can share faces if you want to now, or share voices, whatever you guys want to do. If you have questions, happy to answer them.
So I had a question when we were talking about appraisals. I'm kind of curious if they're how standardized are those, and I guess if one were to be selling a home, or I guess even buying a home, what could they expect to be included in an appraisal that would go into the value of that property?
So when I'm looking at property value, what I look at is everything within half a mile of the subject property. And I am a pretty tight appraiser. I know I've gotten appraisals that were, 4 miles away, thinking that they had to go that far out. Unfortunately, it's not as, I wish it was more standardized than it is. That's the way to put it, because you can get wildly varied appraisal numbers. But this is part of why I'm pretty good at it, is because I do a very narrow circuit. So when I'm giving you what I think is going to be the appraised value, what I'm looking at is everything that's sold within a half a mile of the subject property. That is, and then I first look at everything, and then I'll look at everything that's similar in size and square footage, and then I'll check bedrooms and bathrooms against it. I know that things to look at in terms of losing value or gaining value is, are you on a busy road? A busy street will drop your value, unfortunately. And then condition, can make a big difference in value. Unfortunately, like right now, I don't know. I think some appraisers are still just doing drive-by appraisals as opposed to actually going into the house,
Mhm.
which, is definitely a pain for folks. Because they're not getting, I think, the real view of the property if they're not going into it. Um, so I wish there was more standard appraisal, but it's not as standard as I'd like to. But it does mean that it's arguable. If I do something and it comes in low, I can fight that appraisal too.
Yeah, the lending side, it's a half a mile and within a 10% square foot variance
Mhm.
and built within 10 years, either way of the year built of the subject property,
Mhm.
and similar style house. So if you have a ranch, a standard ranch house, a comparable sale typically is not a skinny house
Yeah.
because those are two different markets.
Yeah.
But then when you buy, the appraiser gets a copy of the purchase contract so they can see the number that they're trying to hit or they're trying to justify. Um, but especially in a multiple offer situation, sometimes I've had appraisals that have come back in low and we go back to the listing agent and listing agent says, well, we had 15 offers on this house.
Mhm.
Well, it doesn't matter. 15 people can write an offer for $500,000, but if the house is only worth 300,000 because all the houses on the street, which are the same, have just sold for $300,000, that's all this house is worth. So it just takes a while for the market to catch up, especially right now when houses are appreciating and people are writing offers over asking. It just takes a while for the appraisers to catch up.
Mhm.
And they will do just a drive-by appraisal. They can do just a drive-by appraisal. But the typical rule is they have to contact the seller and the seller says, I don't want you in the house because of COVID. And then the appraiser has to come back to the lender and say, hey, the seller won't let me in. Can I do a drive-by? And there's definitely pros and cons to that. If you don't know the inside of the house, you can look up the pictures online, but you don't know.
Mhm.
So if we have to get an appraisal, we try to always do an interior and exterior to get the complete value and the complete picture.
Gotcha. Yeah, I think it's kind of what I was curious about. I am currently a homeowner and we've done a number of renovations on our own house. So I'm like sort of curious how that would play into if we wanted to sell down the road, what those improvements would do in terms of the overall value of our house.
Mhm.
Mhm. And the rule of thumb that I use is that your biggest and best money spent on house and in terms of, well, what I first say is if you're only doing it for resale value, don't do it. Do it because you love it, first of all. Second, kitchens and bathrooms are always going to be your biggest money to your best ROI, your best return on investment. Kitchens and bathrooms are always best. After that, keep in mind things that buyers are going to look for in terms of structure. So the kitchen and the bathroom will make them fall in love with the house, but the roof is what they're going to ask for you to replace, right? So, so one draws them in, the other is what they're going to ask you to deal with. If you can do a pre-inspection on your home before you put it on the market, I don't think it's necessarily a bad idea. I am of the opinion that people don't get sued for disclosing too much ever, right? It's better to get a pre-inspection and know what you're selling than um, than wait for the buyer to get the inspection and surprise you with a $10,000 repair, right? And even something as simple as a water main can be not as expensive as you think it's going to be. I literally was at a client's house this weekend where we were digging up some flowers in their front yard to transplant because they decided that they wanted to take some of those bushes out to get prepped to sell. And the homeowner jabbed the shovel in and hit the water main. And we did not think that we were anywhere near where it was supposed to be. Water under pressure from the city will, in fact, go 6 feet in the air. or more. And the city was busy dealing with a main in North Portland, which means that they didn't get there for, I think, it was an hour and a half, 2 hours before they were able to come and shut it off. And I had a key, the key you're supposed to use to turn it off at the street. No, it was broken in the open position and we couldn't close it. And the city guy who made it there couldn't close it. So always check before you dig, rule number one. But that replacement line was under $5,000. So, it's not always outrageously expensive to do those unsexy things too. So.
Cool.
We have a lending question, James.
Yeah.
So I would love to buy a house someday if I can afford it. My sister and I live together and have talked about buying a house together. She makes more money but has bad credit. I make less money but have good credit. That's a common situation, believe it or not. Would it be realistic to get a loan together, or am I better off getting a loan on my own? So what we do is we look at both options. So we'll compare, if you both go on the loan, what can you afford and what is the interest rate and the pricing, versus if you go on your own. And then the third option is with the sister that has bad credit, what can we do to fix it? So can we do something to fix it? Maybe wait 6 months and get everybody in a better situation where it's a better deal overall. So that would be my recommendation on that.
So that's where I say, go and talk to a lender, let James tell you, what can be done and go from there.
Right.
And then Ricardo says, what are the factors to consider when comparing the price and services of your HOA fees? And then a cap. I think the cap when I'm talking about HOA stuff is usually there a rental cap, which is how many people how many units in the condo can be rented at any given time. And try to keep that as low as possible because lenders want that to be as little as possible. The more people who own the homes in there and live in them, the better risk it is from a market standpoint. Then comparing price and services of HOA fees, personally, I think that HOAs are getting more and more expensive in the Portland metro area. When I first started doing this, it was $150 to $250 maybe. Now seeing HOA fees around $400 to $500 is much more the standard than it used to be. And the services provided becomes a kind of a balancing act for you of what's important to you. I know for myself, if I were looking at a condo or HOA, I would not look at something that didn't have a year-round pool because that's an important thing to me. If I'm going to be giving somebody $500 a month, I want access to a pool or a gym as part of that. For other people, that's maybe not necessarily the important part, and they want to know that there's a playground or something. Almost all HOAs automatically include water, sewer, garbage, and then landscaping, grounds maintenance, and most importantly, insurance on the outside of the envelope of the property. So your all of the siding and things like that, the roof, those issues, so that if those things break down, it's then the responsibility of the HOA to fix them as opposed to the homeowner. What you end up paying for is walls in insurance, as opposed to walls out and all of the walls. And if the HOA doesn't have that insurance, then I would stay very, very far away from them. I wouldn't necessarily recommend, it's one of the reasons that I recommend that you make sure you have really good insurance and that you're prepared if you buy a townhome that doesn't have a homeowners association, because you're buying buildings that are attached to each other. So, you're sharing a wall with your neighbors when you're buying a townhome. And if there's no HOA, then there's nothing to say that their insurance is required of your neighbor. So if they get a leak in their roof and they don't have homeowners insurance, the water comes to you, you end up having to pay that. you don't have any insurance, you don't have their insurance to fall back on. So I don't like homeowners. I don't like attached properties without homeowners associations. That's my personal preference. It's definitely a thing to keep in mind when you're buying them. There is a company called CIDA, CIDA, I believe that's their name. And they are, if you're looking at purchasing a home, anything with a homeowners association, um, they look at the records of the homeowners association and make sure that it is solid. They grade it, A through F. Um, and I highly recommend, if you're purchasing in a homeowners association, spending that extra, I think it's, last time I did it, it was $350. Strongly recommend spending that extra money to have somebody who specializes in looking at that. It's just like having me come and look at your stuff as an agent and saying, oh, hey, the roof looks old, but I can't say it's old because I'm not a roofer. I'm not an inspector. I'm not a specialist in HOAs, the people who look at these documents, and that's what they do. And I would spend the money to go with that for sure. I also recommend, if you're purchasing a place with an HOA, that you, as the potential homeowner, try to get in touch with the HOA board and find out how responsive they are. Come up with questions about, how many pets can you have? Or, can I practice my piano at 10 o'clock at night? Come up with questions and go to the board and ask them. And it gives you an idea of how well they respond and how quickly, and, are they a pain to deal with? Stuff like that. So I like places with HOAs, but but they can be tricky.
They have their pros and cons for sure.
They do. And you never know when you're going to find one either. It's not just townhomes and condos. There are some neighborhoods, especially on the west side, where there are still viable HOAs for actual house neighborhoods. And Peacock Lane is an HOA, is a homeowners association. The rule of Peacock Lane, and that's part of the HOA, that you live there, you put your holiday lights up. And Starkwood is the same way. Those do exist. And then you'll find, I found a place in Southeast Portland right off 92nd where nobody knew that there was a homeowners association, but when we, started looking into title and we had pulled the title report, there was an old homeowners association that was no longer in effect. And that happens all the time. And, you run a risk when you buy into a place that, somebody's going to go door to door in that neighborhood and convince everybody there to rejoin the HOA. But think about how realistic that is and how likely you are to get, 50 neighbors to all agree to start putting money back in. Very rarely is anybody going to be willing to do that. So all those defunct ones, I kind of let them slide.
And I think that's good too, to reiterate why you have so many people in your corner working for you. So you have your lender and you have your real estate agent and you have the title company that's doing all the search behind the scenes to make, do a lot of the due diligence for you and help educate you to make sure you're buying the right place.
Annalise, thank you. It's fun. I love doing this. This is like the second, or I think this is the third one of these that I've done, and I really enjoy doing them. So if you guys have any questions, feel free to get in touch with me, get in touch with James. Both of us, we're more than happy to answer as many questions as you can possibly come up with, and at any time.
Yeah, this has been really great. I think we have one last question here before we wrap things up for the evening from Ricardo again.
Yeah.
When they say shopper offer lenders, does that mean you have to pay for the consult and the approval quote with each lender? And does numerous inquiries on your credit score start to affect your score? So it depends who you work with. So we are a broker. So we pull one credit report and all of the lenders that we work with take that credit report. So it's a little bit different than when you go buy a car and the dealer pulls your credit and then they shop it to 10 different financing sources and they all pull your credit. That's not how it works for a broker. But for a bank, like if you go to Wells Fargo, for example, they're going to pull your credit. Then you go to Guild, they're going to pull your credit. Then you go to Director's Mortgage, because they're all individual bankers. So they lend on their own money individually. So you're doing one specific loan application with them. So that's why multiple credit inquiries aren't always the best. But you shouldn't have to pay for a consultation. There's used to be one company in town that charged an application fee. There's one online lender that does still, because they want you to feel tied into using them. And that's, in our opinion, a very bad business decision. So I would rather give you all the advice. And if you don't want to work with me, you want to go work with someone else, that's okay, because I want you to be empowered and have all the information to make the right decision. And that's what's the most important to me. So I think that's, if you're having to pay to get consultations, that's probably not the company you want to be working with.
No, you should never have to pay for a consultation with a lender. You should never have to pay for a consultation with a real estate agent. Never should you pay for a consultation with a realtor. And if somebody is charging you for a consultation with a realtor, please tell me who they are, because I would really like to have a conversation with them about ethical practices. In terms of how people get paid for this, James, we kind of already talked about how the lender gets paid and how that's part of the closing costs that are part of what is in there. And then for me, the sellers of the property have an agreement with their agent to take a certain percentage of that sale and give that to the listing agent. And then that listing agent has an agreement with me, or with the RMLS, the regional multiple listing service, where we keep all of the properties and share information about them with each other, that they will give a percentage to the buyer's agent. So the money that I make as the buyer's agent comes from the seller's agent as a percentage of the sale. I am super upfront about that. It is standardly 2.5% in Portland right now, 2.25% in Washington. Every now and then it goes up a little bit. Every now and then it goes down a little bit. If it's much below that, I'll have a conversation with you about, yeah, I'd love to show you this house, but I need to get paid if we, if we do end up buying it. I'd actually like to get paid for it, and the seller's not willing to do that, so are you. There's a lot of stuff going on right now about that practice and how that works. And I have said from the beginning, when I got my license in 2006, I have said sellers should pay the seller's agent, and the buyers should be paid by the buyers, buyers should pay the buyer's agent. And there's been a huge amount of pushback about that, because it's a belief that buyers can't come up with an extra 2.5% or 2% or whatever we negotiate. And so it's an additional cost. And so for first-time buyers trying to break into a market, they're already worried about coming up with 3% for their down payment or 5% for their down payment. Now they've got to come up with another 2% to pay their own agent. So that's why that hasn't changed, but I like to be real upfront about why I get paid by the seller's agent and why that happens. And then also have a conversation about, yes, I'm an agent who works on commission. I'm a person who works on commission. That does not mean that I'm going to push you to buy the most expensive house that you look at. I am going to have you buy the house that is right for you. And it's not always going to be the amount that the lender, Love You James, tells you that you can afford. Lenders are going to tell you, here's your your percentage of your income that you can afford to buy a house with. That's not always going to be what you're comfortable with in your monthly payment. And if you can't afford to go out for pizza and beer with your friends once a week, when we can do that again, It's not the lender who told you you could afford that you're going to be mad at. It's me because I sold you the house. So I always try to stay as much under the lender's value as I possibly can so that you're comfortable in your house payments. I don't want anybody to be house poor. And I know James doesn't want you to be either. So he's going to be as careful as he can to make sure that the number that he comes up with is one that you're comfortable with.
That's why one of the questions that I ask at the very beginning is, what's your comfort level on a monthly payment? Because what you can afford on paper
Yeah.
/ what you could get approved for is often a much different number than what you feel comfortable paying.
Yep. And this
And
is
so
why I
I
use
don't want you to move in and have to eat top ramen for 6 months and say, that their fault, James. He said I could afford this house.
Yep. And that's one of
So,
the reasons that I use James so much for loans, because there are lenders who don't do that, who are just like, okay, you make X amount and you have this much debt, which means you can afford this much payment. And they don't look at the nuance of that. So
Right.
yeah, I always, that's when I say it's important to use a lender that you can trust. This is why.
Well, this has been, I mean, even as somebody who owns a home right now, like this has been very enlightening. And I wish that I had taken this seminar 5 years ago when I was buying my house. But yeah, thank you both so much for joining us tonight. This was really awesome. And for anyone who is still on the channel, we're going to have this up on our YouTube. You can also look up Deb and Welcome to PDX, and also James and Two Rivers Mortgage on our social channels and on our website and in all of the places. But reach out to these people. They want to make your dream homes come true.
And Meg and anybody else in the chat who either owns or knows somebody who owns who'd like to kind of track the value of their property, the same search that I set you up on when you are looking for a house, I can also use to help track your value. And so I call it my nosy neighbor email. It's super fun for people. This is my nosy neighbor email, and I will send you a note every time something sells within half a mile of you. So when you see the sign go up in the neighborhood, you'll go, oh, I don't have to worry about what that actually sells for because Deb will tell me. And so then I'll send you a note, and you'll get an automated email that says something sold in your neighborhood and this is how much it sold for. So you can look at the pictures and know what's happening in your neighborhood. And once you purchase with me, I'll set you up on that as well, so that from now until forever, you will know. Until you tell me to stop sending you the emails, you'll know what your home value is. It helps people to track that 80% loan to value ratio so that they can get rid of their mortgage interest faster too.
That's amazing.
Yep. Yeah. All I need is a home address, the subject property address in your email, and I'll set you up on it. Take 2 seconds.
So cool.
Yeah.
Well, yes, like thank you both again. This was really, really awesome. And I can't wait until the next time we can do this together.
Thank you. Thank
Yay.
you very
My
much,
pleasure.
everyone.
Thank you all so much. And if you have any questions, it's Deb at Welcome to PDX. And I think it's just James at tworivers.com.
Two Rivers MTG. Yep.
Two Rivers MTG. All right.
Yeah.
Meg,
And
thank you so much
Thank
for
you. Have a
putting
good
this together
evening.
for us, as always. Had a good time. And we'll
Thanks,
do this
everyone.
again. We'll do this again in the fall.
have a good night.
Okay,
All right.
good night.
Thank you.
Night, James.